And then there's just the idea that we don't actually know what's going to happen with our health in the next year, typically. So you're kind of like, I'm like licking my thumb and putting it up in the air to be like, which way is the wind blowing?
Yeah.
Because you just don't know what's going to happen. Hi, Meg.
Good afternoon, Scott.
This week, we get to talk about something so exciting for everyone. They're going to be like jumping out of their chairs because it's going to be that time of the year really soon. Employee benefits.
Yes. I feel as if this is one of those things where, as financial planners, the value we bring is not in exciting our clients, but in like salving their pain.
Yes.
We help them get through it less painfully as opposed to with any amount of joy.
Yeah. It's one of those things where it's like some employers, especially in the stock comp space, right, in tech and biotech, have amazing employee benefits, but it can also feel kind of overwhelming to like go on, whether it's the site or it's the, PDF document that's 86 pages.
Yeah.
Hopefully those are going away. But our hope was today, we'll probably break it up into 2 episodes. We want to walk through the main things we look at when someone says, hey, can you help me look at my employee benefits? And we're going to kind of go through the lens of the biggest levers you can pull, the things that have the biggest impact for you. And then kind of work our way through the other things you might want to consider. Because it's the thing about employee benefits is that it's really just money on the table. Like, yeah, you have your salary, you have your bonus, you have maybe your RSUs, right? But it's like, this is an area where it's like, man, if you really pay attention to these benefits, you can really help yourself out, you and your family. So
yeah, to the tune of, 5
thousands
figures
of dollars.
Easily.
Yeah.
Yeah.
So what do you think is the most important and most common benefit that we help clients with?
Yeah. And just to double down on that, I use the analogy of cake and icing a lot when I'm sort of describing all things personal finance. It's easy to get mired down in all the icing choices, but really we could ignore the icing altogether as long as we have a delicious cake. Mm-hmm. That's what we really need to focus on. And for me, the biggest cake ingredient is health insurance. Mm-hmm. And I think most people, when they think of open enrollment, they think of health insurance and then they get depressed by how unbelievably complicated it is to sort through.
And how many options there are. Like, I've seen some employers where, you'll have the PPO option, you'll have an HMO option, maybe you'll have an option that has a health savings account associated with it. Mm-hmm. So it's a high deductible, high premium plan, an HDHP plan. Mm-hmm. And not only will you have those plans, but then you'll also have the gold, the silver, and the bronze. Mm-hmm. And so it's like quickly you go from having like 3 choices to 9 choices. And you're just like, I don't know what to do.
Yeah. And that does bring up that what we are talking about today is employer health insurance, policies, as opposed to, because I was like, man, if I only had 9 choices to choose from, because I get my family's health insurance through the Affordable Care Act, and there are roughly a bajillion choices there. So that does remind me that we are focusing really on just employer provided health insurance discussion right now. But yes, even 9 can be, the whole analysis, paralysis by analysis, or whatever it's called. So I think we were talking about this earlier, that we both work with a lot of people in the tech space, and these are very analytical people, very focused on this idea of optimizing, focused on the idea of, avoiding taxes, reducing taxes when possible. And all this often translates into, I want an HSA. So I'm going to pick the health insurance plan that allows me to fund an HSA. Because let's say I have a family, the health insurance plan covered my family, so I get to put, I don't have the number in front of me, a little over $8,000 a year.
$300 or something like that this year.
For 2024.
Going up every year.
Yep. Yeah. So it's, roughly $8,300 this year. It'll be higher next year. That's awesome. I get a tax deduction of $8,300, and then I can invest it, as we've actually discussed in a previous podcast episode. It grows tax-free, and then it comes out tax-free. It's triple tax-free. Woo!
Yeah.
Which is awesome, but that's not the end-all, be-all of choosing your health insurance plan.
Right. So the thing that we usually will look at, because that is one thing, right? That's an amazing benefit. that you can get with an HSA plan, you can put that money away and grow it, and you might actually get a match from your employer. Like we've seen often, they'll put $1,000, maybe $2,000 of that 8,300 in for you, which is really cool too. But what you really want to look at when you look at a plan, apples to apples, like if I'm looking at a PPO plan, or like a traditional PPO plan, I'm going to have a premium that I'm going to pay based on whether it's just me in the plan or me and a spouse or me and my family, right? There's usually going to be 3 choices. And then I'll usually do it by the pay period that you're automatically going to have with your employer. So you can take that and multiply it and go like, okay, here's what I'm going to pay annually for my health insurance costs, right? And then you go look at, well, what's the deductible going to be on that plan for an individual and for a family? So for an individual, a PPO plan is going to have a lower deductible than a high deductible, high premium plan, right? It's just designed that way. But the other thing we want to pay attention to is one other component, is this thing called max out of pocket. And max out of pocket basically means I'm going to pay my premiums. If I have a really, really horrific event medically and I go to the hospital, I'm going to fully pay that deductible. But then I'm going to do this thing called a copay, where I'm going to pay a portion of the bill until I hit my max out of pocket. My max out of pocket is equal to my deductible plus my copays until I hit that dollar amount. So now I know what's my total out of pocket expense if things go badly for me in a year. And I say badly, but it doesn't necessarily have to be bad. Like maybe our family is expecting a little one next year and we know we're going to have a hospital stay, right? Yeah. Well, a high deductible plan is going to cost us a lot because we're going to have a high deductible to meet that we're going to pay all of it until we're good, right? Versus the the PPO plan, I might pay a whole lot less that year by choosing that. So I want to know what those numbers are, and then I want to go look at the same numbers with the high deductible plan. I want to know what the premium I'm paying, what's the dollar amount I'm going to put into the HSA. I can back out the employer contribution, of course, because that's them giving it to me, which is nice. Then I want to know what's the max out of pocket, the deductible for myself, deductible for the family, and what's the max out of pockets. And you'll just see you're going to pay way more typically on a high deductible plan in any given year if things go badly versus a PPO plan. So then just weigh that balance for yourself.
We talk about it in terms of, we look at sort of minimum costs for every health insurance plan available and maximum cost. Minimum cost is just, let's say you don't go to the doctor at all. You and everyone in your family in perfect health all year long.
HSA.
What do you still have to pay? You still have to pay the premium. With an HSA, you might get a contribution from your employer to your HSA, so you can subtract that. So if the premium you pay is $2,000 for the year, but your employer contributes $2,000 to an HSA, great. It effectively costs you nothing to have health insurance. And one thing we also look at is the tax savings. If you put money into your HSA, it's going to get you tax savings this year. So that's sort of an anti-cost. We also back that out. So that's the minimum you would pay if your health were perfect. And then we look at the maximum, which is what you were describing. Let's say you end up just having a lot of healthcare needs. Then yes, you're paying the premium. You are also paying all the way up through your deductible and then all the way up through your out-of-pocket. And if you add the out-of-pocket, the maximum out-of-pocket to the premiums you pay, and then also in the case of an HSA, you can back out the employer contribution and any tax benefit you get, tax reduction you get, then that is how the maximum amount of money you would pay on either a PPO or an HMO or an HSA account. And sometimes when you compare the minimums and the maximums, it is dead obvious what the better choice is. The minimums and the maximums are both lower on one policy versus another.
I think the only other thing to note there is, like, if it's to your point, because I did go the maximum because it's always where people are usually just scared. and more often than not, when we run the numbers, a PPO will traditionally cost people more out of their own pocket than if we focus on the HSA being a savings mechanism with the tax savings relative to the premiums they're paying and the out-of-pockets if nothing bad's happening in their life, right? Usually that's a less expensive plan and they get a tax benefit with growth. It's these in-between years that are the ones that I always see people wrestling with. And that's where it's just like asking yourself, like, How much of an emergency fund do I have? How much excess cash do I have every month? How do I feel about having to pay $7,000 out of pocket for medical expenses, even though I'm getting this insurance? Like, am I going to feel okay with that, or does that feel okay to me? Right?
Yep.
That's kind of, it does come down to feeling in addition to the analytics to figure out what the right choice is. And then there's just the idea that we don't actually know what's going to happen with our health in the next year, typically. So you're kind of like, I'm like licking my thumb and putting it up in the air to be like, which way is the wind blowing?
Yeah.
Because you just don't know what's going to happen.
Right. And there are some times when you can anticipate. You had mentioned, if you're pregnant or know you're going to adopt, and then you'll have baby related expenses. And that's something something good you can anticipate. In my life, I got diagnosed with breast cancer a year or so ago. And so I knew going into 2024 that I'd have radiation.
Yeah.
So I knew I wanted to beef up my health insurance plan. And in part, it was just so I wouldn't be blown away by the bills as I got them. Yeah. So it was that cycle. I was like, dude, radiation and cancer is hard enough. I do not want to have this giant bill showing up at my house on top of that.
Wouldn't it, well, of course, you and I have, of course, discussed you and your diagnosis in the past and been friends as you've gone through that. Just for the listeners at home, I'm not going to acknowledge that. And I'm so healthy and okay. But to the point that you're making, you made a choice of I'd rather pay a little bit more monthly for my insurance rather than have all these bills coming at me with really high dollar amounts throughout the year. Yeah. And that's just simply choosing pay more in premium and lower the deductible and the max out of pocket versus being in like a high deductible, high premium plan where you would just have all those bills coming at you.
Right. And it is, the lower the deductible, the lower the out of pocket, just the more predictable the expenses are.
Right.
So it's entirely possible I actually was ahead financially also, but what I was really hoping for, really gunning for was I just want health insurance expenses, healthcare expenses that are more predictable over the course of the year, as opposed to low premium. Ooh, $10,000 bill for radiation, low premium.
Yes.
Yeah.
Yeah. The predictability of it. Absolutely. That's such a good note. Yeah.
Because I will say that I've had a few clients where we've done the math, and the math tells us unequivocally that getting the high deductible HSA eligible plan will net you more money.
Right.
It just will. Under any circumstance, it's going to net you more money. And then they have a big health expense in January, and they have to pay for it 100% out of pocket in order to hit that high deductible. And they're immediately emailing me going, I think we made the wrong decision because I've never had to pay this much money to my doctor before.
Yes.
And so I get it. Here's how it works. At the end of the year, you will see that you have saved money, but I get that in January, it's looking like a real boneheaded decision that we just made.
Yes. And before we move on to the next topic that pulls the big levers, I just want to note that if you do have, whether you're a PPO plan or a high deductible plan, and you have a year, especially early on, where you see you're going to be hitting those out-of-pocket maxes, that's the year to go do everything you've been putting off in your medical life, because the insurance company will be covering that. You won't be. You've already paid your bill. So it's just it's just a reminder. Like if that does happen to you and you find yourself in the place where your client did, there is a slight silver lining to that happening early in the year.
Yes. If you've been sort of delaying medical care that is kind of optional. Like I've got some things I could go to a physical therapist for. I don't need to go. But if we're effectively free because I've already maxed out my deductible and my out of pocket, might as well.
Make it a year of health, right?
There you go. We were just discussing HSAs. And there's often been a lot of confusion between HSAs and FSAs, healthcare FSAs. So let's cover that. A lot of people know what FSAs are. It stands for flexible spending accounts. And the maximum you can put into them in a year, oh hell, I should probably look this stuff up, but it's like $5,500. And you get to put $5,500 pre-tax into a healthcare FSA. And it's use it or lose it money. So if you don't use it by the end of the year, usually you lose whatever you haven't used up at that point. But you can use it for any healthcare expense, and you get a tax deduction on that $5,500. So if you're in the 37% tax bracket, which is the highest federal income tax bracket, you're saving well over $1,000 in taxes just by sort of funneling your healthcare expenses through this FSA.
Right.
Great. If you know that you are going to have any healthcare expenses, let's put money in the FSA. Problem is, if you have an HSA eligible high deductible health insurance plan, you can't use a normal FSA in the same year.
Right.
And you can still use what's called a limited FSA, where you can still put that $5,500 in, but you can only use it for dental and vision expenses. So if you're going to get laser beam eyes,
LASIK, or you're going to have like major surgery on your teeth,
crowns and that sort of stuff,
maybe it makes sense still, but normally it doesn't make sense to do.
Yep.
Or it's not to the full extent, not that full dollar amount, right?
Right. So because any money you put into an FSA of any sort, because there's another sort called the dependent care FSA, any money you put in, you have to use up in the year. Otherwise, you lose it. We usually advise clients to just be conservative about it.
Yeah.
Like, don't max it out if you're not positive you're going to max it out.
Right.
And usually for healthcare, people aren't positive they're going to max it out. Childcare, however, people look at $5,500 and laugh because that's what they spend in 2 months of childcare.
Oh yeah, no, that's to your point. So it's basically the crux is, if you don't use it, you lose it. If it's not an HSA eligible plan, you can do up to that $5,500 in a flexible savings account.
And use it for medical expenses.
It has to be for medical expenses, and you can roll over. I think it's something like $500 year over year, but it's not a large dollar amount. So really, it's just only put money in that you're going to use it for. And then you did note really quickly dependent care FSA. So I just want to bring that up briefly. If you have two spouses that are working, you are allowed to, for one employer, you can put away, well, I guess technically you do two, but there's a max number you can put
between the two employers.
Between the two employers, you can put away, is it $5,500 this year also?
Something
around
like
$5,000
that.
or $6,000.
Yeah.
Which is the laughing part, because it costs way more than $5,000 or $6,000
to put your child in full day daycare. Yeah.
Yeah, but again, you're putting money away before you're paying taxes. So you're getting that savings on the taxation to basically help fund a couple more weeks of daycare, right? And I would note that any schooling that's an accredited school during the school year does not count, right? And you can find articles on this too about what counts and what doesn't. But what often does count are in the summertime, where in our school, at least around here, everyone does summer camps all the time as a form of daycare. And that would count for most of the of those camps that exist. So just recognize, like, what would you use it for?
Yeah, that's actually a good sort of warning to give people, that if you think you're going to put money into a dependent care FSA and use it to pay a certain service provider, make sure that the kind of service provider it is actually eligible for dependent care FSA dollars. Right. I've had clients get bamboozled by that before, because the FSA sort of provider, the company that administers the FSA, they don't care. They're not the IRS. If you submit some sort of receipt that says childcare, they'll give you money out of your FSA. When it comes time to file your taxes, the IRS is interested in way more exacting paperwork.
You're saying this in a really nice way. I'm just going to cut to the chase and be like, you can't pay your babysitter next door cash and then use an HSA to claim it, because she has to file a tax return. And if she's not filing a tax return, you're in trouble, right? Like,
what?
Or it could be
I
someone
wasn't just trying to be nice.
Who's like, because sometimes people are like, I want to pay my person under the table, and I'm like, well, you do you. The right thing to do is to pay them above the table for many reasons, but you cannot pay them out of an FSA then, because it's going to be run down through the government, and they're going to say, prove to me that this person was paid.
Right. Yeah, I mean, but I wasn't just trying to be coy. There are other childcare providers, totally legitimate, above the table, that people, I've had clients sort of reasonably expect would be eligible FSA providers.
And then they're not.
And they just aren't.
I thought you were just being coy. Okay.
No.
And then, of course, health savings accounts, you are a part of that too. Health savings accounts, you can put away that $8,300, which we already talked about, or half that if you're single. And then, of course, you can invest those too, which we already have a previous episode on.
Yes.
Okay. I feel like this is a good stopping point because we have a lot more to cover.
We got through health insurance in one episode. I feel as if that's a legitimate success.
Well, it is the biggest lever that people are going to pull that they don't know what to do with. So I think it's great that we did this, and we'll be back for the next episode where we will look at all the other levers you can pull through your employee benefits.
One last thing I will say, especially because I'm in a position where I know the full freight of health insurance for my family, that your health insurance benefit is worth 5 figures to you. My family pays just over $20,000 a year for a very high deductible plan.
Same.
For a family of 4.
Yeah.
So your health insurance for a family of 4 is probably worth $20,000 to $30,000.
Yeah, no, I think it's something that some companies are better at this than others, but they will actually show you total compensation for you for the year. And health insurance is one of the major reasons we see people stay in corporate jobs and not become entrepreneurial.
Yep.
All right. Well, until next time.
All right. Ciao, Scott.